Here's 5 personal takeaways from the crisis and how it changed conventional wisdom. First, investors do not act rationally in a crisis. They don't buy low and sell high. They buy high and they sell low. In the week of March 6, 2009, the S&P hit 666. Yikes, a drop of more than 50% off the historic high. It made no sense at all to sell with the market down 50%, but that's exactly what happened. Outflows from mutual funds accelerated towards the end of 2008 into the first quarter of 2009. The flows did not turn positive until later that year. That hurt. Second, there isn't always a right price. When the mortgage-backed security market fell apart, no one could agree on how to price the derivatives that were at the heart of the crisis. The mortgage market seized up, and that affected other credit markets. Third, increasing complexity does not decrease risk. It increases the risk. Everyone thought you could slice and dice mortgage products into these manageable tranches that would spread out all the risk. That proved to be terribly wrong. Fourth, the markets are not as efficient as everybody assumed. Wall Street had very poor visibility throughout all of this. I saw it. Corporations were seeing business deteriorate on an almost daily basis, and poor communication and data sharing from the companies themselves exacerbated the problem. Many companies provided little, if any, guidance and shared as little information as possible, and the analysts were terribly wrong on their estimates. Finally, bold, swift action works better than slow, indecisive action or no action at all. The Fed stepped in to make sure banks would not fail, and that finally stopped the free fall. And in a sense, John Maynard Keynes did win out. Governments around the world stepped in, propped up critical institutions, and they spent a lot of money. And I would note that global central banks did this as well. And we're still debating the effects of that.